I am Nicolas Bornozis of Capital Link, and I would like to welcome you all to Capital Link's webinar today on the topic of setting the stage for 2022. I'm delighted that we have with us a team of major shipping analysts who follow the listed shipping companies, and we are going to have a discussion on their market take for shipping for 2022. We have with us, I will go around as I see the windows on the screen, Mr. Ben Nolan from Stifel, Randy Giveans from Jefferies, Chris Wetherbee from Citi, Jørgen Lian from DNB, and Omar Nokta from Clarksons, Platou. I would like to thank you all for the great work you do for the industry. Also, I would like to thank you for the great cooperation that we have developed over the years. And thank you for joining us today. Before I start the Q&A, just as a matter of logistics, our discussion is going to have to be along three major, if you want, axes. One is sector fundamentals. Second, company strategy, what should shipping companies do in the current environment. And then the third one is on other major topics like consolidation, shareholder profile today for shipping companies, and so on. Please, anyone who would like to submit a question, at the bottom of your screen, you have the Q&A button. You can submit your questions. They come to us, and I will address them to the analysts. Feel free to submit them during our discussion, or email your questions to us at questions@capitallink.com or webinars@capitallink.com. By the way, the usual disclaimer, our discussion is purely for informational and educational purposes. We're not here to provide investment advice or advice of any kind, and clearly Capital Link has no responsibility for the content of our podcast. And with this, I will welcome you all. Thank you, Ben, Randy, Jørgen, Chris, and Omar. So let's start with what you see right now in terms of shipping has had a great year in 2021. Actually, you know, one of our panels was our October forum. We called it "Shipping, Is It All Glitter and Gold?" And then I think Ben came out with the report, am I right, saying that the party will continue. So I'd like to ask all of you, what do you see for shipping in general in 2022, and then go sector by sector. I have asked each one of you your sector preferences, which sectors you are most optimistic about for 2022. So Randy and Chris have indicated that containers are your favorite sectors. So maybe I can start. Chris, maybe you can kick off and tell us why you think containers is the name of the game in 2022, and then I'll have Randy back you up.
Sure. Yeah. And thanks so much for hosting this, Nicolas. Really appreciate the opportunity to chat with everybody on the Zoom. So yeah, I mean, containers is a group that had an enormous amount of strength over the course of really the last 18 months. So clearly container kind of won the pandemic, if you will, in terms of capacity restriction, congestion being an issue, spiking rates, obviously profits are up significantly for the liner companies, as well as the folks who are taking advantage of, you know, the improved charter market. Our expectations for 2022 is that congestion is going to linger. We do think it gets better, but we do think it lingers for a period of time where we don't see a material improvement probably until the back half of the year. As a result of that, you're going to have atypical seasonal patterns pretty much throughout the year with elevated rates that'll continue. Our coverage is focused less on the liners coming out of the United States. My colleagues overseas cover those folks. We cover more of the charter operators, the capacity owners. And so there's a bit of a lag between what we're seeing from a spot market perspective and what they're going to see from a charter perspective. And so what we expect to happen is while rates, you know, are at elevated levels and arguably will decelerate to a degree as the year progresses, which generally speaking for an early cycle group would be a negative, we see our charter players, capacity owners, continuing to go through a rechartering process, which will generate a significant amount of upside from both a revenue and then a profit standpoint. Some of the companies in our coverage, we could see, almost doubling of EBITDA when we look at 2022 and maybe a tripling of EBITDA from 22 back to 2020. So we still see a lot of upside potential. And then the cash flow created from this upside is going to be pretty robust. And we think there's the ability for them to deploy that capital. We've seen some other investments outside of containers specifically for a couple of the carriers, but we also would expect to see, returns to shareholders be fairly robust. And I think there's just more growth opportunities for these folks. So overall, we would expect, what has worked to continue to work here. And I think congestion is going to be the theme of 2022. It will get better, but we think it persists long enough for these folks to continue the windfall that they've seen.
So thank you, Chris. Randy, if I come to you, what are the elements that make you believe that containers is the top performing sector in 2022?
Yeah, hey, thanks, Nicolas. And as Professor Wetherbee said there, we also agree that kind of congestion lingers for longer than a lot of people expect. We saw rates, quote unquote, peaking in October. A few weeks, the rates fell off by 2, 3, 4%. Everyone thought that was the beginning of the end. And then since November, rates have only gone one direction, and that's higher. And then as it pertains to the container ship owners, the lessors, like a Danaos, a Global Ship Lease, right, they're chartering ships for 3, 4, 5 years at these elevated levels. So they're locking in some extensive cash flow here. And then we cover one of the liners, Zim Integrated, and clearly they're just making money hand over fist, right? 4Q's clearly going to be better than 3Q. They've already guided that 1Q now is going to be better than 4Q. So do we think rates are going to stay at these levels all year? Of course not, right? Demand is going to subside. You're going to see a little bit of switching back to spending on services and all of these other factors. But, just like Drew Brees, everyone said he peaked in 2017. Well, he didn't fall off a cliff the next 3 years. It was a pretty good 2018, 19, and 20, right? So the same for the Zim and the liner companies and rates there. Although they might really peak in the next few weeks or months here, we think the rates throughout 2022 are probably going to stay above anything we saw before mid-2021, right? So that said, 2022 full year average rates will probably be better than 2021. And 23 should be pretty elevated as well. So although rates may be falling slightly over the next few months, we're still very optimistic just looking at the underlying supply demand fundamentals from both the liner perspective as well as the container ship owner lessor.
It is very interesting what you mentioned, Randy, and of course you, Chris, that we do see the container ship owners log in multi-year charters at high rates, which shows that the expectation of the market is to continue to be strong. At the same time, I think there is going to be a lot more deliveries as of 2023. So it is kind of interesting to see how that will play later on. But I think right now, obviously, companies have the opportunity to lock in very good rates. And now Ben had mentioned in one of his reports that he was expecting freight rates for containers to go down in 2022, which might give us a different perspective on this market. I don't know, Ben, if you would like to comment on that.
Yeah, I mean, to be fair, Nicolas, you're right, I do. Although I would venture to say that probably everybody on the panel does think at some point before the end of the year, container rates are probably going to go down from where they are right now. So I think the question is, are we not necessarily are we sort of headed upwards as much as are we plateauing, and then at some point does it normalize? Rates at these levels are unsustainable. They're too high and they'll draw in competition, and at some point they'll come down. But to Chris and Randy's point, if we stay here for a while, these companies are going to make a lot of money. I do think that by the end of the year, that rates are very likely to be half of where they are now, or maybe even less than half of where they are. But that would still be pretty high. It would still be reasonable. There's a chance that it could be worse than that and we could overcorrect. I think that's probably more of a 2023 or 2024 event. But yeah, the trick for me on containers is how much credit does the market give to a persistently strong duration, even if there's an expectation that there's going to be a roll-off at some point. And I think you see that in a lot of aspects of transportation right now, where things are elevated, but there's an expectation that they're not going to stay elevated forever. And so do you want to, how much is the market willing to chase? And it's tricky. I think this is a tricky time to be a transportation investor.
Hey, Nicolas, let me just jump in with one other point to make, which I think is interesting. And I agree with what Ben says in terms of the way the stocks work. And I think that's probably the biggest risk when we think about containers is investors expecting that roll in rates and discounting it aggressively ahead of time, because I think that's always the way transport broadly works, and shipping as well, in terms of being early cycle and highly cyclical. People will sort of look and sort of discount peak valuations or peak earnings and put more sort of mid-cycle on what they expect to be more normalized mid-cycle earnings. I think the interesting thing to sort of see how this plays out in late 22 and then into 23, once we start to get vessels to deliver, I think what the market needs to do to prove to people is really show that discipline. So I think it really kind of goes back to 2017 when you saw the Hanjin bankruptcy. I think we began to see a significantly increased level of discipline from the players in the space. We'll see how that plays out. Ultimately the ability for blank sailings to increase at the levels that we saw back in 2020 when things were tough, in order to preserve the rate environment and manage that capacity coming into the markets, can be very, very interesting. I don't know that this group has been all that well tested in that respect, but it does appear that there's a significantly increased level of discipline in the space. So I think that's going to be an interesting thing to see play out over the course of the next, call it 18 to 24 months.
I'd also add, Nicolas, if you don't mind, and I agree generally with the conversation thus far. It does feel like this is a bit different. And Randy, you mentioned Drew Brees. I'm wondering that it definitely feels like the container market's much more like Tom Brady, right? At the moment, it just continues to even get better.
Sure.
And we're starting this year off at record run rate, as you highlighted. And I think what may be different is, typically liners operate under a spot contract, quarterly, maybe 12-month contracts, but now they're starting to see interest for 2-year and 3-year freight agreements, which really changes the game all that, substantially, because they can lock in, fairly high record rates for an extended period. And I think what will be very interesting is what happens as we get to February, because that typically is that sort of pivot point to a firmer market. And if you recall back in the fall, in September and October, when freight rates were starting to get very high, congestion was peaking, governments were starting to get involved in noticing, hey, we have to do something. So a lot of liners came under pressure to react, and several put in rate freezes for that October to February time period. So February, that's coming up here around the corner. What are they going to do? Are they going to push rates higher, because clearly the spot market's indicating that rates should be, they should be able to charge more, or will they keep a freeze in place? But in any case, these companies are substantially stronger than at any time in their history. I mean, for an industry, right? Liners themselves, I believe, as we look at the whole sector, in the span of 18 months, the entire industry has gone debt free, or nearly net debt free. So that gives you a lot of ammunition and a lot of strength as you look forward. I think that the freight rates may come off, but these equities, I think, are going to be much better positioned going forward.
Omar, thank you for this comment, because actually you had given me containers as one of the lowest preference for you. So,
you may have asked me that 2 weeks ago, and then a lot's changed in 2 weeks.
But it is really quite interesting, and we will conclude with containers. By the way, Jørgen also had rated containers as one of his least favorable sectors. So maybe I can ask him before I make my concluding remark and move to the other sectors.
Yeah, sure. But I think I tend to agree with a lot that's been said. I think that the difficult question is rather what's being priced into the equities today and how our equities have to react once things turn around. The one thing I do know is that shipping historically, once things turn, it happens fast, and the equity markets tend to discount in a lot of negativity once things and the arrows start to point in the wrong direction, to put it that way. So I agree. Things are looking stellar, and they've continued to be very strong for longer than we had thought. And any indicators as to when that might end have been very elusive. So as things stand, the super cycle that we're seeing today just seems to continue. But that being said, a lot of positivity priced in, and my take is that once things start to turn, you start to discount in the substantial fleet growth that's coming to market in 2023 and 24. But we've been playing around with the idea for a bull case. If you don't see the congestion issues ease before you get these deliveries in 23 and 24, what are you going to do then? All of a sudden you have 15% more capacity in the fleet waiting in queue in those same ports, and then all of a sudden it becomes a port issue and not really a shipping issue. And that's been something that's been important to look at as well in container shipping so far in this upcycle, is that it doesn't really, it's not all about the shipping balance, it's about what goes on the land-based side of logistics.
Clearly, but I think obviously when we look at 23 and beyond, it's quite some time away. But I think at the present, as we all pointed out, container companies, they are locking in multi-year contracts at very hefty rates. So from a cash flow perspective and balance sheet health, I mean, this is a good position to be in. And of course, 2023 and so on, maybe it's another story, but I think for the time being, these companies seem to be in a good spot. Now, it's interesting to move away from these multi-year charters and go to maybe the more spot trading, go to the crude market, to the tanker market. Ben and Omar had indicated the tanker market as one of your top picks. And I think the tanker market, crude and product, it's a market in waiting for a turnaround. What is your take on those? Maybe I can start with Ben, and then Omar, please come in.
Sure. So I'm thinking about the crude market sort of as the opposite of the container market. Right now, it is really bad, and it's been really bad, similar to how the container market's been really good. And I don't think there's a catalyst to cause it to, or at least not any obvious catalyst to cause it to get immediately better. So I think the first half of the year is going to continue to be rocky for these guys. You are seeing OPEC add production gradually, but we're still below where we started all of this in 2019. And if you look at the IEA numbers today, we don't get back to where we were until the third quarter. Now, that does lend itself to a little bit of gradual tightening, but certainly first quarter already, and probably the second quarter is going to be choppy. I think by the third quarter, things start to look pretty good. And again, it's, at least from my view, we're opposite of where the container market is. You're getting underlying demand growth and rate improvement that sort of is counter to what you would see on the container side. But and for that reason, and we put out in late December, that if we're saying any one category of the shipping market that has the potential for the most upside, it's the tanker market. But with the caveat being, it probably doesn't materialize until the back half of the year.
So
generally agreement with you, Ben, and I think it's clearly, I hadn't thought of it from that perspective, that you have opposite ends of the extreme curve of containers versus tankers. But yeah, clearly, I feel at this time last year, we were optimistic that a tanker recovery was visibly on the horizon, and we thought it could start to really take shape in the second half of 21. And the equities actually started off extremely strongly for the first 4 or 5 months of 21. A lot of people really were excited about the opportunity for crude tankers and broadly the tanker space. I think the equities were up 40-50% during the first few months of last year. And then it became obvious, oh, wait a second, this sector needs a lot more time for recovery. And I think what's proven is simply the fact that there's just way too much slack in the system. There needs to be a lot more production in the marketplace and crude exports. And so we're roughly about maybe, call it 4 million barrels a day missing from the market at this point that is due to come on stream by that September, October time period. And so we get to that point now where we're back to where we were, as Ben mentioned. And a lot of the questions that we get is, okay, great, we're going to add those barrels. Well, then what? How does the tanker market look then? Are we talking about it looking like containers or dry bulk at the highs last year? Or is it just a recovery to some 30, 40,000 a day tanker market for VLCC? And I think that's been the biggest question that a lot of investors have, in that, okay, we can understand the recovery is coming, but what's the velocity of that recovery? And is the opportunity to make a lot of money there for these companies? And that sentiment, I think, is being sort of tested and questioned as to, can this recovery truly happen in a meaningful way? And our view is absolutely, that once you bring those barrels back, the market becomes functionally tight. And then you look forward, and one of the attributes of being the last to recover, I guess, is the fact that there are no slots available for the tanker sector for the next 3 to 4 years. And so you have I would say, a structurally tight tanker market that as soon as the market recovers and rates improve, they're gone. Rates are going to be firm, we think, for a very long extended period. And one of the things that I think is very interesting at this point in the cycle is that, as Ben mentioned, it's going to be potentially a pretty sloppy 6 more months to go here. But what's interesting is how active the sale and purchase market has gotten for tankers, how there's a lot of cash buyers coming in a meaningful way, and they're bidding up values substantially higher than anything we've seen over the past, I would say, 5, 6, 7 years. And so if you look at what could potentially happen, a lot of these tanker companies who may be struggling to get to that second half where there's going to be a better period, they have the opportunity to unlock some cash with the value appreciation that we're seeing today.
Hey, Nicolas, I would agree. I think crude has got some intriguing dynamics beginning to build. I think Omar hit it right on the nose. If you look at that secondhand vessel value beginning to kind of inflect more positively here, should be a good leading indicator to what's going to happen with rates here. And I think that's a very astute point. This bridges the gap to a better, more profitable scenario potentially in the back half of the year. I think everything with oil prices where they are, maybe production beginning to creep back up, I think all of sort of the directions of the market are beginning to look neutral to sort of positive. And I think from an equities perspective, that's usually a pretty good time to be thinking about it. Containers are top pick, but I think, crude and tankers have to be looked at here.
Yeah, and I would agree with, I was just gonna say, I would agree with Ben that clearly tankers have the most upside, right? In terms of rates, the market is very weak right now. But I agree as well that container rates are going to be falling. Even if they get cut in half, they're still at great levels. Even if tanker rates double, they're still not at great levels, right? But that said, the equities, certainly some of them are still drastically mispriced. Clearly trading at 35, 40% discount to NAV, most people are currently pricing in a very elongated, very weak tanker market, no recovery in sight. Now, clearly the supply picture is pretty good after the next 6 months, right? A lot of new build deliveries coming on the water in the next, 2 quarters. The inventory levels finally below the 5-year averages. So you have that kind of hurdle behind us. And really it's just demand, right? And how quickly we get demand back to pre-COVID levels. Is it mid-year? Is it year end? Is it 2023? But we do expect demand to kind of slowly, gradually grind higher. The fleet is going to increase over the next few months, but then should drastically slow thereafter. So we agree that tankers have a lot of upside, but we're pretty much on the sidelines until, late 2022.
Jørgen, you had pointed out that the crude and the product markets for you were lower down in your list. So what is your take on those?
Yeah, but I completely agree with Omar. So on the 4 million barrels per day is missing. So the question is just when those will get back. And I think if you look at the production increases that have been driven by OPEC cuts being reversed recently, you've had a lot of producers struggling to meet their quotas. That's the first thing. The second part is that you haven't actually seen that production being translated into exports yet, which is a bit strange. It's probably bound to happen at some point, and therefore we're more in agreement that it's probably an event looking to happen towards the back end of this year, when things are back to, let's call it, utilization levels fundamentally that compare to where you were in 2019. But then I just want to mention, because 2019 has become sort of the benchmark year and what we're looking at to get back to. But remember that when we were entering 2020, we had regulatory effects on the supply side, which curbed supply of crude vessels at that time. Number two, we had Venezuelan sanctions that also impacted the fleet towards the back half of that year. So you had a few one-off events on top of the underlying utilization levels that you can calculate to. And if you're aiming to get back there, that's at least a starting point to see things take off at least meaningfully.
So Omar mentioned that the S&P market in tankers is quite active and robust. What do we see in terms of the in the charter market? Do we see primarily spot trading? I've read that we have seen indications from a number of oil majors coming in for longer term contracts, which indicates exactly their expectation that the market might strengthen, so they'd like to lock in lower rates. What do you see in that area?
I would, Nicolas, I would highlight that I would say that there has been a bit more of an uptick in chartering activity that I would see, or I would say it's tough to tell whether that's just playing a winter arbitrage opportunity and entering into 6-month, 12-month contracts. But I would say it's substantially more obvious what's going on in the sale and purchase market, where people are putting big money behind assets, whether they're VLCCs, LR2s, MRs. There's a lot of inquiry in the market, and it's forcing us to really rethink what are these ships actually worth. Because at the end of the day, to order a brand new VLCC costs $115 million. That's up, what, I want to say 30 million from a year ago. So there's some structurally or firm asset pricing on the new builds, but it's starting to filter into the secondhand market, which shows that there's some relationship between the cost of steel and what a vessel is worth. Clearly, we know that. But two, and I think much more importantly, is the fact that you have a significant amount of buying interest at this point in the cycle. And it's not happening across the board. I mean, clearly there's firm container ship values, there's firm dry bulk values, but what's going on in tankers is substantial strengthening without the freight market being there. And so just as it definitely shows that there's some expectation of a real recovery. But I would say that from my perspective and seeing some of the fixture activity out there, there has been some time charter activity, but the sale and purchase market has well eclipsed that.
Yeah, I think at these levels where spot rates are and where broadly the rate environment is, it's really difficult to see significant depth to the charter market. I just don't think you're going to get asset owners who are going to commit at these levels. So yeah, I think you got to look at the asset prices probably more so than anything if you're going to get bullish on the space.
No, you're right. I mean, the point I made was that obviously owners are taking the spot route for good reasons. But I had seen exactly that some of the owners had mentioned inquiries from oil majors, and that meant if they wanted to lock in rates now, lower rates, it indicated their expectation the market might turn around. Before we move on, can I ask maybe Ben or any difference between crude and product?
So from my perspective, I think product has already been doing a little better. And we would expect that to remain the case in the near term. But a little better off of where we are right now, still not very good. I think as we move into the back half of the year, should the crude tanker market really inflect, I mean, usually it is very rare where the smaller ships lead, and crude and product are not exactly homogeneous, but they're close. And certainly the dry bulk market at the moment can make a case where, hey, maybe there are opportunities where the smaller ships can do better than the bigger ships. But I think it all comes out in the wash at the back half of the year. And if and when we do see a more proper recovery, you generally want to be more aligned to the bigger ships. Fundamentally, has product captured share 100%, but I think they're still going to be correlated, and at least we would advise people that probably the easiest path to owning the market is probably with some of the bigger crude names.
So let's move now to the dry bulk.
If I could just add a quick comment, which I think is very interesting in terms of you mentioned the inventories previously that have come down quite substantially, and I think if you want to put a positive spin on the product story versus crude, there's nothing better than very limited inventory in certain regions of the world of different, refined oil products. And if you get these short-term arbitrages that drive up volatility of different types of cargoes, then traditionally that has been a very good driver for MR and LR trading activity. And so our take on the low inventories as you see them right now, I think will be more inclined to see life in the freight market for the product guys rather than the crude guys, at least in these short-term windows.
Thank you. Let's move now to the dry bulk side. Jørgen and Randy had given to me that dry bulk was their second best choice. So Randy, maybe let's start with you, since Jørgen just concluded his remarks. Tell us your take on that market.
Sure. The dry bulk market obviously is coming off a very strong 2021. And unlike recent rallies or market strength, this is not driven by cape sizes and iron ore going to China and pulling up everything else due to cargo splitting. This is driven by the smaller asset classes, the supras, the ultras, the handy sizes, taking all kinds of commodities to all different regions, right? So it's a much more global, stable strength. And then you get the offshoots of a few extra coal cargoes, a few extra iron ore cargoes, and cape size rates at 85,000 a day in October, right? So when you have that underbetting of a very strong small size asset classes and the rates there, it leaves a lot of opportunity for the post-Panamaxes, Kamsarmaxes, and obviously the cape sizes to rally. Now, clearly, we are in the seasonally soft period, right? The heart of it, coming up into Chinese New Year, coupled with the Beijing Winter Olympics. You just had this Indonesian coal ban. Now you have all the steel production curbs in China for the Blue Sky initiatives and getting ahead of those holidays and the Olympics. That said, give me 6 weeks from now, and I think rates are materially higher, right? There's going to be a lot of pent-up demand to bring in more iron ore. The flooding that's happening in Brazil, I think 6 weeks from now, that will be pretty transient. So Vale is going to be increasing their production and exports out of the country. Coal imports are continuing to rise, grains, minor bulks. So it's an extremely stable demand outlook. We're talking 3 minimum up to 5% kind of a demand growth this year. And the supply picture is extremely attractive, 2% at most in terms of fleet growth for dry bulk. So when you look on a year-over-year basis, demand's going to outpace supply. So are we going to see the same rates in 22 that we saw in 21? Maybe, maybe not. But will we see very strong and very profitable rates for pretty much all of the asset classes? I'd confidently say yes. So that is why dry bulk, just looking at those underlying supply-demand fundamentals, is extremely attractive here. And then quickly on the balance sheets, I don't know, we'll get to this more later in the conversation, but the balance sheets for these dry bulk companies are the best they've maybe ever been, or certainly since 2007 and 8. So in that environment, they have a lot more flexibility to continue paying dividends and using the cash wisely during a possible soft patch over the next couple months. But again, for the full year 22, we're pretty optimistic on dry bulk.
So Jørgen, what is your take? And do you see this strong market continuing beyond 22?
Yeah, I think if you look at the order book to fleet ratio here, things point in the direction that this could be perhaps the early days of an improving and lasting upcycle. I think with all the technical uncertainties surrounding what type of new buildings you're bound to order, and also the impact on the demand side from potential phasing out of coal, I think this. It makes the decision to do that new building order much harder, and then of course that benefits those companies that have vessels on the water today. So our view on the dry bulk space, if we look sort of to the equities markets, is that that would be essentially the opposite of what we've seen on the tanker side. I think there's been immense optimism on tankers with every sign of life in that space over the past year, while you were far from factoring in the amazing rate levels that you saw towards the back end of last year in dry bulk into the equities. And I think despite rates having come down as much as they have now, on our rate forecast for Cape is just below $25,000 a day for next year, and you're looking at the equities being capable to return 25% dividend yields, and I think that's a sector that's bound to grow in the long term, and also where the equities are very attractively priced.
So go ahead,
Nicolas. Can I just add one other comment on dry bulk, just to follow up Jørgen and Randy's comments? I think one interesting thing about dry bulk in 21, which was clearly a phenomenal year, the best since 2008, it was that it bucked the trend of two things that historically would never happen. One, it was led by the Handys and the Supras, as Randy mentioned, but then also you had the Chinese really taking a step back and not being the driving force for the dry bulk market. And when we look at, I want to say Chinese GDP growth last year was somewhere around 8% growth, I think, in 21, and yet steel production was down 20%, I think, in the second half of the year. And so they artificially reduced their steel consumption, and by extension their iron ore requirements. With winter on the horizon, with an energy crisis, they backed off. They wanted to conserve a lot of the construction demand. The energy usage, they wanted it away from construction and into the consumers. And at the same time, you have the Winter Olympics, again, as Randy was highlighting. It'll be interesting to see what happens come March onwards with the Chinese back in the market. Theoretically, there's going to be a substantial amount of pent-up steel requirements and iron ore needs. And so you may end up having a very different 2022 for dry bulk, another very, very strong year, but this time with the iron ore story back in play and with the Chinese back in play, which we didn't see last year.
So traditionally, the wintertime is a softer period for dry bulk because of the Chinese New Year. Do we see this happening now? My understanding from our discussion is that this year, the impact will be a lot less. Am I right?
No, I feel, Nicolas, I would just say, I feel like it's been probably much more pronounced this year. The weakness that we are seeing has been, the Chinese voluntarily backed away from producing steel. They tried to keep steel production at bay, and I think approached most steel mills and said, listen, reduce your steel production for the final 4 to 5 months of the year. And so you had the steel production declined, and then with the energy crunch, a lot of conservation of energy for personal use, not the industrial use. And then on top of that, you've got the storms in Brazil and whatnot that's also limiting cargo. So I feel like if there's been any year where we've had an exacerbated seasonality, it's been this year, both from natural causes due to weather, but then artificial causes due to the Chinese regulatory conditions.
Yeah, I think you throw in the fact that you have the Olympics and the New Year together. I think that actually does add to the seasonal effect that Omar and others have been talking about. So I think that's right.
I think one of the things that over the weekend I was doing some data crunching, and in the past 7 years, the weakest months of the year for dry bulk every single time have been February, March. Every time over the past 7 years. If you go prior to that, though, it was completely random. It was all over the place. And I think what you've seen is the Chinese are playing a bigger role in sort of dictating that absolute sort of tipping point on supply and demand. I agree with Omar that last year they weren't quite as impactful, but for now, and I think probably going forward, they don't like having smog in the winter, and that's going to have an impact on how much stuff they import. And so I think we're now in a much more predictable pattern of seasonality than we had been when China was a smaller player.
Before we move on to LNG and LPG, can I ask you, if we look ahead, you expect the strong market fundamentals to continue for some time. At what point are you becoming a little bit less clear on how the market will? I mean, if I look at supply-demand balances, at what time point in time are you becoming less clear?
I think if you move to a period when there are open slots at the yards, it's always difficult to be very adamant as to how things will develop. But that being said, we ran this long-term outlook that we put out some time back, looking all the way to 2050, which is more of a, let's say, demand-driven take, given the energy transition that we're looking at going forward. And one of the main oppositions to investing in the dry bulk early on of this so-called ESG wave was that they carry coal. Therefore, you're looking at the declining demand pattern in the coming years. We found that is very interesting, playing around with the sensitivities of numbers, and given that you've had the long-term average growth, let's say maybe 3% or so, if you very rapidly remove that coal from the outlook in terms of demand for dry bulk shipping, you affect that 3% demand growth with 0.8 percentage points. So just to illustrate, how small of an importance that actually has, in the entire mix here. This is actually a segment that carries a lot of things that aren't energy carriers, and given that in the context of uncertainty around regulations and low order book, I think this sector is probably one of those that are lined up among the very best, at least, for outlook in the longer term as well.
Thank you. So let's move now. By the way, when I asked all of you your preferences and I added up, I had a sort of a Nicolas rating system. Dry bulk came out to be the top choice across the board on a cumulative basis. Now the next one actually is LNG. It's very interesting that we see in the LNG space that a lot of the public players are being taken private. Does this indicate how attractive this sector is? So who would like to take a stab at LNG, LPG?
I'll go. Yeah, I'll take LNG at least. Clearly it's been a fantastic ride. And yeah, it is too bad. A lot of the companies were taken private by some big, deep private equity pockets who probably saw something in the long term, but also recognized that the equity markets were maybe a little slow in providing the proper valuation per se for the sector. But that's really, LNG has turned around in a meaningful way. You've obviously got high LNG prices in the spot market today, and a forward curve over the next few years is very elevated. And so for us, that finally brings back or rejuvenates the trade to a point where any liquefaction plant globally is running at or near max capacity and is induced to do so because of record prices. And the forward curve implies that every plant out there, especially out of the US and all the new plants coming from the US Gulf, are going to be running at max capacity. You throw in a lot of volatility recently between Asian prices and European prices, and it's just created a bit of a sort of a standoff in overall near-term trading activity. And that's what we're seeing in terms of headline rates. Because of lack of arbitrage, spot rates have come down, but the actual amount of cargoes moved has remained very, very high. And most charters have been looking for vessels on long-term contracts. And right now they've, I would say since March of 21, so the past, call it 10 months, it's been a very active charter market. And especially now, even with spot headline rates coming off, there's a lot of demand for 3-year and 5-year contracts, which had been missing really, I would say, since 2014 and 15. So you got long-term contracts coming back into the fold, which is the companies that were public weren't able to capture. And so as an MLP, which a lot of them were, without long-term visibility, it became a big question: is how can these companies thrive? They all go private, and then now there's 5-year contracts being awarded again. So the outlook to us looks very, very strong, and just ideally there'll be a bit more public companies to discuss.
Yeah, and on the LNG side, the order book's very similar to containers, right? It's 24, 25% of the fleet, but two things. One is a lot of those vessels aren't delivering till late 23, 24, 25. And secondly, a lot of them are to replace steamships, especially come IMO 2023, 26, 30, whatever it may be. So for those two reasons, we think the fundamentals are very strong there for LNG shipping as well. As Omar mentioned, the liquefaction utilization is very high, with LNG prices in the 20s in both Europe and Asia. And then the supply growth is pretty low relatively for both 2022 and 2023 for that matter. So on the LNG shipping front, we think there will continue to be some geographical arb opportunities. You know, we've already seen Germany and other European nations kind of say, oh, well, you know, gas is green too, right? They try to get away from it, but realize, okay, we need gas, especially in the next 5 years. So on the LNG front, we're pretty bullish. And I think you asked briefly about LPG. There is the same story, right? Especially in Asia, even in India, demand for LPG is very strong and rising. The order books there for the VLGCs is pretty elevated, but mid-size, handy-size, all the smaller LPG order books are very low. So LPG is certainly a sector that is probably a little under the radar, but we think as well demand should outpace supply growth, at least for the next couple of years.
I'm a little bit more cautious. I mean, there has to be a dissenting opinion somewhere or another, and I'm a little bit more cautious on the LNG side. I think as I look at, I mean, clearly the rates have fallen a little bit near term, and I do think that they'll improve from here as you get a little bit more balance between Asia and Europe in terms of buying, and that'll happen in the next few months. But I think in this year, there's not a whole lot of new production capacity coming online. There you have a little bit from the US, a little bit from a few other places, but it's a relatively unremarkable year with respect to incremental cargoes. Next year, it starts to ramp up, and 24 starts to look even better. But to Randy's point, I mean, that's really when the new vessel orders start to kick in, and really it's less about those assets being earmarked for replacement and more for being earmarked for new projects. So I think I wouldn't say that I'm negative or bearish on LNG, but I think it's going to be a relatively unremarkable year. Just kind of ho-hum, you know, a little ups and downs, but on average, unremarkable.
So before we go to the second section of our discussion, I plan to ask to start with Chris. I wanted to conclude the first one with a question to Jørgen, who has brought in a Scandinavian specialty. He mentioned that his topic is the car carrier sector. So Jørgen, the floor is yours. Take us through the car carrier segment and why is your topic?
Yeah, I just I found it missing in your list and felt the need to scream out. It's been a sector that's gained a lot of traction among investors over the past 6 months, and rightfully so. If you look at that space, it's been a bit out of favor, you can say, for the past 10 years in cyclical decline. But now all of a sudden you started to see the rates improve. And the positive of being in a cyclical decline for 10 years is that over the past 5, you haven't invested anything in fleet renewal. So you're looking at close to 0% fleet growth in this space for the next, or this year and next, before you start to see some new deliveries entering the fleet from 2024 onward. But that's still rather limited. And the average age of the fleet is approaching 15 years. So you need to remember that the clients in this space, they're they're large OEMs, which are incredibly interested in getting down their carbon footprint across the value chain. And of course, an average age of 15 years in a fleet that hasn't been invested in for some time makes a good story when you look at the potential for supply growth going forward. And then if you factor in that things are already starting to improve, but you know you're coming from a situation with a lot of bottlenecks on the production of vehicles, you're bound to see volume growth on the demand side materialize as well. What would that mean for rates? In our view, it's a clear-cut case of rates just being negotiated upwards as contracts are renewed in the coming couple of years. And I think that space deserves some attention.
Thank you.
I'm with you for what it's worth. And if there are any car carrier companies listening, I suggest you list in the US. I think that it's a really compelling story. US investors would like to hear.
So let's now go. We may have to exceed our time by a little bit, if you don't mind. Let's go to the second section of our discussion. Shipping, as we all know, is it's a very important sector for us. We work in this space, and shipping is a vital link in the global supply chain. However, you know, the listed shipping companies have been a smaller part of the overall capitalization in the US. And I think with all the supply chain problems and bottlenecks, with the no shipping, no shopping motto, this has brought shipping to the horizon of a much broader investor universe, the much broader public. So how do you see the investor interest in shipping today? Clearly, shipping has had a stellar performance. How do you see the new shareholder base and the new investor base in shipping? Chris, can I start with you? Do you see more interest coming from institutional, from individual investors?
Yeah, it's a great question. And this has always been, I mean, I've been covering shipping since 2005. This has always been the single biggest issue from a shipping perspective, sitting in my seat. And you know, maybe my peers here will agree or disagree, is that there is a fairly small subset of investors who care about the space. I think from time to time, that group grows a bit, and then it shrinks a bit, and it grows a bit. We're probably in a scenario where marginally it's growing. And obviously the success in some of the equities, as well as the attention, to your point, that's been, you know, focused on it, I think has probably increased the audience a bit. I would still argue it is a fairly niche segment of the market. And so from our perspective, inbound has been better. Certainly container gets a lot of attention and has for a while now. And like you said, that's the headline. We can see the 100 ships stacked up off the port of Los Angeles. And that's been, you know, in the news on a regular basis, including the nightly news. So it's pretty mainstream at this point. But then on the other hand, you got, you know, VLCC rates where they are, and that ultimately kind of takes some attention away from the other, because you have these still have these real big peaks and valleys. And I still struggle to find the average investor outside of the people who are specialists willing and interested in tolerating that degree of cyclicality in market caps that are this small. So we don't have a lot of trading volume. We have relatively small companies. I think that's an issue. We have been significant advocates for consolidation. I know I'm kind of just, you know, kind of shouting into the wind to a degree, because I know there are significant barriers to that consolidation. And so we're going to be realistic about it. But the truth is, we need real larger market cap companies in this space for people to get, you know, significantly more interested. So I think we're expanding. Things are better than where they were maybe a couple of years ago. But I think there's still an awful long way to go for this to become more mainstream.
Along your point, Chris, if we look at the role of shipping in the global supply chain, more than 90%, I think, of global cargo is moved on ships. So when I compare shipping to the other modes of transportation, trucking, railroads, airlines, clearly shipping has a dominant role. However, the other modes of transportation, I know you cover a wider universe, tend to have a bigger following, maybe because they are more traditional, if you want, they're more common to the average investor. But I would believe that now shipping can really get its position in the industrial supply chain and the global supply chain much more visibly than in the past. Do you see that in terms of the investor interaction you're having?
I think that you bring up a really good point. Listen, the liner companies are big companies, right? So you think about Maersk and other folks who are out there, those are real companies that have meaningful size. And so if I think from a global perspective, and even some of the Asian liner companies, there is interest in those, and those are becoming more of a discussion point within the context of the industrial landscape. It's the US listed side where we are significantly behind the rest of the world in terms of market cap and as a result, trading volume. And so, if I think about my truckload space, which is typically viewed as sort of one of the more commoditized spaces within sort of the land-based transportation, frankly, the smallest truckload carrier I cover is probably bigger than 95% of my shipping coverage. And I think that in and of itself is a significant issue. So globally, yes, I think there are some players, and they are becoming more intertwined with the way investors think about, broader supply chain and industrial complexes. But, the US needs to see some more of that market cap to get people excited.
But now following on that point and opening to the rest of you, consolidation. Clearly, consolidation has merits from a Wall Street perspective. But when you go to the owners, they have a different perspective. Shipping is a very fragmented industry. A lot of people feel that small can be equally efficient as being a bigger company. So how do you see more consolidation happening, not just for Wall Street purpose, but in the industry, and along those lines?
Yeah,
I think. Go ahead. No, go ahead.
No, go ahead, Nicolas. Finish your question.
Along those lines, when you have single-purpose companies, dry bulk only, tanker only, container only, clearly you bring to the investors specific choices, and you let them reap the benefits of the cyclicality and the investment momentum. On the other hand, take, for example, the case of Navios that put together a much bigger company, diversified across several sectors. Containers, dry, and tankers. So, which in a way underscores the industrial nature of shipping. How do you see that happening, consolidation and single versus multi-sector strategy?
Yeah, let me touch on a little bit on the previous question first, because they kind of blend together. As Chris was saying, a lot of those other areas of transports are basically oligopolies, right? You only have a handful of companies. Be it airlines, trucks, rails, whatever it may be. So with that comes pricing power. With that comes much larger market caps and all of those things. So blending into your second question around consolidation, we have seen it, right? Look at International Seaways and Diamond S, right? They just had a big merger last year. NMM kind of rolling together and all these other entities. So we do think consolidation will continue. Also, to your earlier question around investor interest, it really is the have and have-nots. Not many investors are calling me asking about $100 million market cap name. A lot are calling me about the 2, 3, 4, 5 billion market cap names, right? So it really is bigger is better, especially when it comes to investment interest in that regard. So lastly, on your kind of integrated versus specialized companies, it's hard, right? Not everyone wants a diversified play when they can make their own kind of diversified play by buying a dry bulk company, a container company, a tanker company, and then having their own basket there, versus NMM, which has all three. Now, as a company, it certainly stabilizes your cash flows, and there's some kind of a negative correlation between a Capesize and a VLCC and a container ship. That said, when it comes to investment community, a lot of them still like the specialized nature of, a Euronav, of a Starbuck, of a Danaus, right? Three separate buckets that they can kind of make their own portfolio approach.
Omar, maybe.
Yeah, I guess that's the issue, and I think the jury is still out to see, how NMM in that structure works long term. Conceivably, that's one that makes more sense from, as Randy put it, you make everything just a bit more smooth in terms of earnings. So you may have capes that are doing very well and an offsetting tanker weakness, or you might have all three doing well or whatnot, but you get the opportunity to enter into long-term contracts in one business and use that as a base for investing and whatnot in other businesses. I think overall, though, you've heard me say this before, Nicolas, the size of the investing community is just so much larger than what's currently investing in shipping. And at the moment, those who prefer to invest in a single, whether it's a tanker or a dry bulk company, those are primarily hedge funds that typically they're not there throughout the cycles. They come, which makes sense when there's an opportunity to make a lot of money going long, and then similarly they'll short in a meaningful way when they see the market turning. But you don't really have that long-term mutual fund capital in the sector consistently. They come, but after years of improvement in a certain sector, like we've been seeing that in containers and dry bulk the past couple of years. But that real sticky money has really not been able to be there for conventional shipping outside of the liner industry. The liner industry has, whether as we have Zim here in the US, you have several of the big liners in Europe and Asia. Those do attract mutual funds, but the conventional, call it tanker, dry bulk, those two sectors typically just only attract hedge funds. And I think time will ultimately tell. And the longer this sector stays strong, and the more really consolidation does happen, because consolidation's always been viewed as not necessary because you don't get that many economies of scale, but you absolutely get it in terms of access to capital, both equity and debt. And so the larger the companies get, the more attractive they become to a wider audience. And by getting larger, you are diversified, and thus you attract a substantially larger mutual fund community, which is about 8 to 9 times the size of the hedge fund community.
For what it's worth, I'm not expecting a lot of consolidation this year. And the reason is that normally, as we saw last year, normally you see consolidation when the markets are really weak. And so we did see that with the tanker market last year, but we didn't really see it in areas where the companies were generating good cash flow and didn't feel compelled to do anything. So, as we go into this year, I think most categories, with the exception of tankers, have done pretty well. They don't need to do anything. And maybe you get a little bit more in the way of tanker consolidation, but I think this is going to be sort of a quiet year on the consolidation front.
So we are now in a period that shipping, most sectors are doing very well, and we have sectors in waiting to turn around. So you're a shipping company. How do you maintain your profile in the investment community? How do you reward your shareholders? How do you bring in new investors? I have 2 questions that are different. Number one, are a lot of stocks trading below NAV? And if you are trading NAV, how do you contrast that with the very robust cash flows that you have contracted to bring in? And the second question that I will ask, and maybe we can talk about it later, is how do you implement a policy to capital allocation? What do you do with the very robust cash flow you're bringing in? Dividends, growth, share buybacks, debt payments? Let's focus on the first question. So who would like to go first? Maybe Chris, I can start with you.
Sure. Yeah. And I apologize in advance because I'm actually going to have to wrap up here relatively shortly. So let me kind of make a couple of comments here about sort of what companies might need to do. I think some of the things that we've talked about, consolidation, I think in some cases mixed fleets might need to be sort of the path forward to smooth out the cyclicality of the significant peaks and valleys that we have within the individual subsectors. So things like what Navios is doing might ultimately end up being a smart thing. I know people want the pure plays, but if we're going to build bulk and scale over time, maybe that's something that they need to do. I have a lot of companies in my coverage trading below NAV. To answer your question specifically, that has been a stubborn benchmark, I think, for many years for lots of different sectors to be able to kind of exceed that on a sustained basis. We sometimes see that at the inflections of the cycle where we begin to give credit for rate environment and a couple of quarters out, and we see that upside. I'm not sure I have a really good answer for how you kind of solve some of those issues, but I do think just sort of building scale is going to be, key to, some of the more successful ones. As Randy pointed out, right, you get calls on the big companies, you don't get calls on the small companies. Over the last 3 years, I probably covered more $100 million market caps or lower than I ever have in my career. And that's just not not good for anybody. It doesn't do me any good. It doesn't do investors any good. And it frankly doesn't do the companies any good. So at that point, they become a lot less relevant in terms of investor interest. So, that's, I guess, my perspective on it. But yeah, the valuation issue is a problem. I'm not sure exactly what solves it.
Can I ask you, NAV is a moving target. The value of your fleet goes up, and obviously your NAV goes up and down depending on market movements. On the other hand, you have a very robust cash flow generation. Shouldn't that be the main focus rather than NAV?
I've always thought so. I mean, I think that's really all you care about, right? Is the future cash flow of the entity. For better or worse, I think people use the NAV as a benchmark for that to a degree, suggesting that the S&P market's going to be able to sort of discount that as well as anybody else is going to be able to. And it's also what you do with that cash flow, right? There's a long and storied history of people potentially maybe not doing what's in the best interest of shareholders with that cash flow. So I think there are some hurdles to that. But I think ultimately, conceptually, academically, absolutely.
So you open the door to a second question. What do you do with the cash flow? I mean, do you pay down debt? Do you give dividends, share buybacks, fleet growth? Would you have any suggestions to the companies you work with?
I think shareholders want you to return it to them in many, many instances, right? I think that is something that we've seen pretty consistently. I'm not sure that's changed materially, in my opinion, and maybe other folks have different perspectives, but I think generally speaking, shareholders like to get that capital back and use it in the way that they see fit.
I would say, while I generally agree with that, I think things might be changing a little bit, or maybe they should change, because if companies aren't going to be valued at NAV, then somehow or another, if we are going to see growth and the companies are going to be bigger, then they're going to need to internally fund that growth, because depending on the capital markets, if they don't have a good currency, is really expensive and not very profitable. So I think, yeah, it is nice to pay dividends, but if I were some of these corporate management teams, I would say, okay, well, hey, the name of the game here is asset allocation, right? Is being a good steward of capital, and sometimes that means holding cash and waiting until you have a good buying opportunity, because you can't depend on the market to provide you that liquidity. So I'm sort of a self-help proponent at the moment, I think.
Yeah, and Nicolas, I'm all for debt pay down when your net debt is 50% LTV or something like this. When it's 30, 25, 20, do you need to go to 10 or 5? Probably not, especially in this very low interest rate environment where debt is basically free for all intents and purposes, and rates are going to be rising right over the next few years. So I think a 25, even 30% loan, net loan to value is probably a good amount of leverage. You can certainly be under levered. So paying down debt to that point. And then when it comes to capital allocation, yeah, you can buy secondhand ships for sure, especially if your shares are in the NAV range, 85 to 110%. If your shares are 60% of NAV, it makes all the sense in the world to just repurchase shares, right? Especially if you're out there saying, when our shares get to 120% of NAV, we're going to issue shares to buy ships. Well, the inverse should be true. If you're 70% of NAV, you should sell ships and buy shares, right? So that's kind of our priorities for capital allocation. Now, every company has its own nuances, but that's kind of a broad general statement there.
If I may ask you, if you have a choice between share buybacks and dividends, would someone have a preference or a suggestion?
I think it's valuation dependent. I'd say a lot of companies might be too small to be buying back shares in an aggressive manner anyway. So that's one of the challenges. I don't disagree with Randy's point. It is probably valuation dependent. That is another factor to consider, though.
Sure.
Sorry.
Well, I mean, it's counterproductive to some extent if we're talking about bigger companies being more attractive and then you're aggressively shrinking your company. I think you're not taking a step in the right direction.
Would you expand your fleet in the current market environment, given that in some sectors asset prices and freight rates are very high?
I think it depends really. It's, you know, if there's an opportunity, I think a lot of times shipping has been, a lot of people have bought, you know, they'll have 10 ships, the market gets better, then they buy an 11th. And that seemingly makes sense, but also you need to ask yourself, is the demand there? Are your customers requesting that 11th ship from you? And if you can say the answer is yes, particularly if there's a contract component that comes with it, then absolutely. But, you know, expansion may, it depends honestly on where you are in the cycle. And I feel like at this point where there's a lot of unknowns and there's still a lot of question marks on technology, it feels like you should be reinvesting in the business and just retooling, not necessarily expanding, but more if you have 15-year-old ships, sell them and replace them with 5-year-olds, and you just continue to modernize your fleet until the technology starts to come to fruition.
So we're approaching the end of our discussion, but you opened up the very important door, very important topic, decarbonization. How do you see the drive to decarbonization and regulation having an impact on shipping and on capital expenditures, fleet renewal, and so on? And that brings also in the question of the alternative fuels. What is your take on that? Who would like to go first?
Jørgen, go for it.
Okay.
So you have been silent for some time, so let's come to you.
I will. So yeah, I think the backdrop for you know, being positive to the wider shipping space, I think relates a lot to that question. And I think the potential for seeing limited fleet growth relating to that risk and uncertainty that comes along with this decarbonization drive, coupled with elevated capex levels on aging fleet that isn't necessarily as efficient as the modern one, I think is going to be a theme for several years ahead, driving limited fleet growth and hopefully better times for shipping in general, really across sectors. So that we're bullish in regards to regulations. I think that that helps us along quite nicely.
A lot of the people that I speak to, you know, they expect exactly regulations as they kick in, EEXI compliance and so on, to drive lower speeds in the industry. Lower speed means longer voyage times, less ship availability, therefore taking supply out of the market. Do you see that as one of the parameters of?
Yeah, that's one thing. So we've already seen an impact on the supply side from the IMO 2020 regulations with increased fuel costs. They're probably going to keep the vessels sailing at lower speeds than they were prior to 2020, and that was the first step. Now, looking ahead with all the EEXI regulations and CII regulations coming into play, that's also going to set limits on how quickly you can move cargo at sea. But perhaps even more important in the short-term picture, I think, is the capex requirements that are going to relate to the EEXI, which will be an interesting event in 2023 already. So the future is here, also for shipping. So
companies with newer fleets, eco-friendly assets have a competitive advantage?
Both yes and no. I'd say the conundrum really is that essentially what you want is a short-dated asset to take advantage of very strong markets in the near term, and you don't necessarily want that tail risk on the 20-25 year asset life. So that's a mixed picture. But of course, when you're competing in poor markets, you're usually better off with the modern assets, while when you're in the booming market, I'd opt for the 10-year-old perhaps.
Yeah, I would add that seems to be where a lot of the value that, or in the S&P market, there's been a lot of activity in that 5 to 10 year age range. You take advantage of a strong market or an anticipated strong market, like say for tankers, but you also want to have eco design qualities. And so that's where I would say the S&P market seems to have the most activity at the moment, is in that that middle age of eco design class.
So we have been together for 75 minutes. I appreciate enormously your insight. If you don't mind, let me go around and ask for concluding remarks from everyone. Let me start by thanking you for your tremendous insight and for your contribution to this webinar and to the industry in general. So maybe, Chris, I can start with you and I can go around and have some closing remarks from each one of you.
Sure, not too much for me. I really enjoyed the conversation. I think these are, a bunch of really smart guys who think about shipping all the time and who've got great insights here. Like I said before, we continue to think container is a great place to put capital to work, and we're starting to see some size develop in some of those companies. So that's really what we're focused on. But thanks, Nicolas, for the time. I really appreciate it.
Ben?
Well, it's always more civil when Chris is on these panels, which is nice. But similarly, I appreciate the time and once again, for however many years, Nicolas, you've always been kind enough to include me in these things, and I appreciate it. But it's an exciting time for shipping, I think, from a macro perspective. But at the same time, we're sort of, in my view, in tricky markets, right? Where it's probably more important now to time the investment than it has been in the past, and be nimble in entering and exiting what those investments are.
Randy?
Yeah, thanks again. Obviously, Nicolas, really enjoy all of these panels and all the work with Capital Link. I would say clearly 21 was pretty much a record year, right? Our average shipping equity was up like 73%. 11 of them more than doubled, some of them tripled, right? So 21 was really a gangbusters year. 22, we expect continued strength and especially outperformance of the S&P or even the Russell 2000. So do I think shipping is going to average another 70-80% gain and the Russell and the S&P going up 20-25? No. But could shipping do 30-40% and the S&P flat? Highly likely, right? Especially with this big shift from momentum growth investing to value investing, energy related. I think that's getting some more love here. So I do think shipping is the place to be in 2022, and we're excited for it.
Thank you. Jørgen?
Yeah, thanks for organizing, Nicolas, and Capital Link, and not too much to add. Just leave you with our view that we believe the dry bulk looks particularly interesting going forward in the coming months, along with, of course, the car carriers, which would be our two topics into 2022.
And echoing on Ben's suggestion, please get them to list in the US.
Yeah, well, I'd say we can offer an investor base that's very familiar with what you do. So stick to us, please.
Okay. And Omar, the concluding remark with you.
Yeah, and also thank you very much, Nicolas, for putting this together and including me and inviting me to participate. And obviously you and the team at Capital Link are very, very much engaged in the shipping market and excellent ambassadors of the industry. So very happy to be participating. And yeah, concluding remarks on my end are, 21 was a great year for shipping broadly. We expect more of the same in 2022 with some a bit more excitement for tankers as we get closer towards the end of the year.
Thank you. By the way, I'd like to say we have the great opportunity to work with all the stock exchanges. I mean, we work with Oslo, London, the two New York, of course. So it's in line with the global nature of the industry. So as long as you're a quality company, you can be listed anywhere and investors will come and find you. So thank you to all very much, and enjoy the rest of the day. And this will be available for replay for those who would like to access it later. Thank you very much.
Thank you.
Thank you.